Today we're taking a closer look at something that's been generating a lot of buzz lately, target income ETFs.
Specifically, the YieldMax Target 12 series.
Yeah, these ETFs are promising a steady 12% annual income stream.
Sounds almost too good to be true, right?
Right. So we're going to break it all down for you. We've got prospectuses for 5 different ETFs in this series: Semiconductor, Biotech and Pharma, Energy, Real Estate, and Tech and Innovation.
They all share the same basic structure, but we'll highlight the nuances for you.
Exactly. So our mission today is to figure out exactly how they plan to hit that 12% target.
And what makes them different from your average income ETF.
And, of course, the potential advantages and drawbacks of this approach.
We'll also sprinkle in some fascinating tidbits from the world of finance.
Always love those. All right, let's start with the 12% target. How exactly do these ETFs plan to deliver that?
Well, the funds aim to distribute 12% annually, paid out monthly.
Monthly?
Yep, based on the net asset value of the fund on the last day of each month.
Okay, so let's say the fund is valued at $10 per share at the end of the month.
They'll pay out 12 cents per share, so basically 1 cent per share each month.
Interesting. So even though it's called Target 12, it sounds like they're actually aiming for a 1% monthly distribution.
That's right.
Got it. And will those distributions be paid out regardless of whether the market is up or down?
Yes, regardless.
Okay. So then how do they generate the cash to make those distributions? I mean, 12% a year seems pretty ambitious.
It is, and this is where things get interesting. These funds are not your typical income ETFs.
What do you mean?
Well, a lot of income ETFs rely solely on dividends or bond interest. These don't.
Oh, okay. So how are they generating income then?
Primarily through option strategies.
Options. I know they can be a bit complex.
They can be, yeah. But to put it simply, the fund managers sell or write, as they say, covered call options on the underlying securities in the portfolio.
Okay.
Or on ETFs that track those securities.
So just to make sure I understand, they're selling these options, and that generates income.
Think of it as collecting a premium. Like you're giving someone else the right to buy those assets at a predetermined price in the future, and they pay you for that right.
Ah, okay. So they're generating income from these premiums.
Exactly.
And that happens regardless of whether the underlying assets go up or down.
Right. And that income is what fuels those monthly distributions.
Gotcha. So that's the key difference from traditional income ETFs.
Exactly. Think about it. With traditional ETFs, those payouts are tied to the performance of the underlying holdings. So if the market is flat or down, your income could shrink.
Right.
But with these Target 12 ETFs, they're aiming for that consistent income stream no matter what the market does.
That's a pretty appealing proposition for income-focused investors.
It is, but it's important to understand how this approach differs from those more traditional income ETFs.
In what way?
Well, most income ETFs are passively managed.
Right, meaning they track a specific index and just distribute the income generated by the underlying holdings.
Right, exactly. Like a dividend ETF that tracks the S&P 500. But these Target 12 ETFs are actively managed by Zika.
Meaning what?
They decide which options strategies to use. You know, they can adjust their approach based on market conditions and their outlook and all that.
So it's a more like hands-on approach.
Yeah, you could say that.
They're not just passively collecting income, they're actively trying to create it, right?
Exactly. But with that active management comes both advantages and disadvantages.
Okay, let's dive into those. What are the potential upsides of this target return approach?
Well, the main advantage is the potential for that consistent income stream. Aiming for a fixed 12% distribution can provide predictability for investors, especially ones focused on income.
Right, like it can make planning your finances much easier.
Exactly, knowing you have that target income coming in,
Yeah.
especially in retirement or for those relying on their investments for income.
Makes sense.
Additionally, these ETFs offer diversification by investing across multiple sectors: semiconductor, biotech, energy, real estate, tech.
Oh, right. So that helps mitigate some of the risks associated with a single industry.
Exactly. And then, because of that active management style, there's potential for upside appreciation.
So they're not just aiming for income, there's potential for growth, too.
Right. Unlike those traditional income ETFs that just track an index, these funds have the flexibility to adapt to market conditions, potentially generate returns beyond that 12% target.
Interesting.
Zika, the firm managing these ETFs, they have a history of developing options strategies with the goal of, enhancing returns.
Okay.
Of course, no guarantee they'll always succeed, but the potential's there.
Okay, so we've got potential for consistent income, diversification, and even potential growth. Sounds
Mhm.
pretty good so far.
Yeah.
But I know there are always two sides to every coin. What are the potential drawbacks? What do we need to be aware of?
Yeah, no investment is perfect. I think one thing to keep in mind is the complexity of the options strategies involved.
Right.
They can be tough to understand. And there's always the risk that the fund managers could make the wrong call.
Yeah, that makes sense. And I imagine there's no guarantee they'll hit that 12% target every year.
Exactly. It's a target, not a promise. Market conditions can change so rapidly, and the option strategies that work well in one environment, they might not be as effective in another.
Okay, so there's inherent risk. Got it.
Uh,
What other drawbacks are there?
well, another thing to consider is the fees.
Right, because you're paying for the expertise of those fund managers.
Exactly. Actively managed ETFs generally have higher expense ratios than passively managed ones.
And those fees can eat into your returns.
Exactly. So it's important to weigh the potential benefits against the costs.
Good point. It seems like these Target 12 ETFs offer a really interesting alternative to those traditional income investments.
Yeah.
But it's crucial to understand both the potential rewards and the risks involved. Like, these funds might be a good fit for someone who's really looking for that consistent income stream and is comfortable with a higher level of risk. But for investors who are prioritizing capital preservation or are less comfortable with complexity, a traditional income ETF might be a better choice.
Yeah, I think that's right.
It all comes back to understanding your individual investment goals and risk tolerance.
Exactly. And remember, these Target 12 ETFs, they're a relatively new innovation.
Yeah.
It'll be interesting to see how they perform over time, especially in different market conditions.
While you were talking about potential drawbacks, one thing that crossed my mind is, what happens if the underlying assets in the ETF perform really well? Do investors miss out on some of that upside because of the option strategies?
That's a great question. And it brings up another potential drawback, yeah. Because it's true that by selling those covered call options, the fund is essentially capping its potential gains.
Oh.
So if the price of the underlying security goes above that strike price of the option, the buyer will probably exercise their right to buy, and the fund will have to sell the security at that price. So, yeah, there is a possibility of missing out on some of that upside potential.
I see. So it's like a trade-off, right,
Yeah.
between the potential for that consistent income and the potential for explosive growth.
Exactly. And it highlights the importance of understanding those specific option strategies the fund is using and how they can impact returns in different market scenarios.
That's really helpful. So we've talked about income generation strategies, the potential advantages and drawbacks of the target return approach.
Yeah.
But there's another aspect we haven't touched on. You mentioned that these funds invest across multiple sectors. Can we delve a little deeper into that, like how those sectors are chosen and how they impact the overall performance of the ETFs?
Of course. Each of the 5 ETFs in the YieldMax Target 12 series, they focus on a specific sector: semiconductor, biotech and pharma, energy, real estate, and tech and innovation.
Right.
And Zeka, the fund manager, they conduct a lot of research and analysis to select companies within those sectors that, they believe have strong potential for growth and income generation.
So they're not just picking the biggest companies in each sector, right? They're looking for companies that align with their investment strategy.
Right, exactly. They're aiming to build a portfolio of companies that they think can deliver both that income and that potential for capital appreciation.
Got it.
And that's one of the key things that differentiates these ETFs from those traditional sector-based income ETFs.
Okay.
Because a lot of those funds simply track an index of the largest companies in a sector, without really considering their individual growth potential or income-generating capabilities.
That makes a lot of sense.
Yeah.
It's like they're taking a more active, strategic approach to building those portfolios within each sector.
Yeah.
But I'm curious, how concentrated are these ETFs?
That's a good question. These funds are actually pretty concentrated compared to some other ETFs. They typically hold between 15 and 30 companies within each sector.
So the performance of just a handful of companies could really impact the overall performance of the fund.
Potentially, yeah. But that's where Zige's active management comes in. They're constantly monitoring the performance of the companies in their portfolios and making adjustments as needed to try to mitigate those risks.
So it's a balancing act, I guess, between focusing on companies with high potential and diversifying enough to manage the risks.
Exactly. And it's something that investors need to be aware of when they're considering these funds.
Okay, so we've talked about income generation strategies, the potential advantages and drawbacks of that target return approach, how the ETFs are structured, those concentrated holdings within each sector. But there's one more question I have. These funds aim for a 12% distribution, but what if the income generated from those option strategies doesn't quite reach that? What happens then?
That's a great question. And it's something that's addressed in the prospectuses. If the income generated from the option strategies falls short, the fund may need to dip into its principal to make up the difference.
Wait, so the value of my investment could decrease, even if I'm receiving that 12% distribution?
That's right. It's called a return of capital.
It seems kind of counterintuitive, right?
It can, to receive distributions that could reduce the value of your investment. But it's important to understand the nuances of how it works.
Okay, break that down for me. So if the fund is distributing more than it's earning, it's returning a portion of my original investment back to me.
Exactly. And that return of capital isn't taxed as ordinary income.
Oh.
It's considered a reduction in your cost basis, which could lower your tax liability when you eventually sell your shares.
Interesting. So even though it might seem like I'm losing money because the fund is dipping into principal, it could actually have tax advantages in the future.
Potentially, yeah. But it's always a good idea to talk to a tax advisor to understand the implications for your own individual situation.
That's a good point. So, all right, we've covered a lot of ground here.
Yeah.
We've talked about how these Target 12 ETFs aim to achieve that target return, the advantages and disadvantages of this approach, and even, some of the more detailed points like return of capital.
Yeah. But they also have a really specific approach to managing risk.
Oh.
They call it the Zega Dynamic Allocation Model.
Okay, what is that?
It's basically a system that helps them adjust the fund's exposure to different asset classes based on market conditions.
So like how much of the portfolio is in stocks versus bonds, for example?
Exactly. It considers things like market volatility, interest rates, even economic indicators to figure out the best way to allocate assets.
So it's like a built-in safety net.
Yeah, you could think of it that way. It helps protect the portfolio during those times of market turbulence. It's designed to mitigate losses and boost returns by dynamically adjusting the portfolio's exposure to risk. It's not about, eliminating risk completely. It's about managing it in a way that aligns with the fund's objectives.
So Zega is being proactive in both generating income and managing risk. But how does their approach compare to other active managers in the ETF space? Are there any other funds out there that use a similar strategy?
It's a great question. And while there are other ETFs that focus on income and use options, Zega's approach is pretty unique in a few ways.
Like what?
Well, first, their focus on a specific target return, that 12% distribution, really sets them apart. Many other income-focused ETFs don't have a set target.
Right.
Their distributions can fluctuate depending on market conditions, so investors in those funds might not have that same level of predictability when it comes to their income.
So Zega's target return approach offers more consistency.
Exactly, which can be really appealing for those income-focused investors.
Makes sense. What else is different about Zega's approach?
Their active management style is another big one.
Okay.
See, a lot of ETFs that use option strategies have a more rules-based approach, where they're buying and selling options based on a predetermined set of parameters. But Zega takes a more discretionary approach.
Okay.
Their team of portfolio managers actually makes decisions based on their analysis of market conditions and their outlook for different asset classes.
So they're not just following a set of rules.
Nope. They're using their expertise to try to, outmaneuver the market.
Which could be a good thing or a bad thing, I imagine.
Exactly. Like, if their analysis is right, they could generate some really significant returns. But if they make the wrong call, it could impact performance.
It's a bit of a gamble, then.
You could say that. It's like any active management strategy. There's always that element of human judgment involved.
Right. So it's really important to carefully evaluate the track record and expertise of the fund manager when considering those actively managed ETFs.
Couldn't agree more.
Well, this has been a fascinating deep dive into the world of target income ETFs. Thank you so much for sharing your insights with us.
It's been my pleasure. I always enjoy getting to geek out about finance.
And a big thank you to everyone listening out there. We hope you found this episode informative and, engaging.